This module will build on the financial basics to present the common elements and formats for budgets used by management, both within organizations and to communicate costs to stakeholders and potential program investors. Budgeting is a fundamental and dynamic management skill, not a once-a-year exercise to be performed by the CFO and approved by the board. The ability to accurately identify the resources needed and the total costs related to a particular activity, program, or organizational endeavor is essential to maintaining an operationally strong and mission-driven organization. Familiarity with budgeting practices and the ability to break down and modify a budget as needed can be what separates your organization from sustainability and closing its doors.
So the goals of this lecture are to explain the purposes of a budget and introduce the standard budget formats used by nonprofits, as well as the content included in them. We don't like to admit it, but in almost every instance, a budget is an educated guess. In well-run organizations, it's an educated guess that's based on historical knowledge of what the organization has achieved in the past and is tempered by the environmental realities of what is happening economically, politically, or environmentally around the organization, and it results in a plan stated in dollar terms. A budget is more than a series of numbers. A budget is a management tool that allows us to control our spending. How do you know if you're spending too much if you don't have a bar or a target that you're hoping to reach and not go over? It helps us go through the exercise of allocating resources. If we all have limited resources, and on this project, is it more important to hire a full-time program director or to get the best possible quality food for the soup kitchen? It's a decision that is going to be represented in your budget. Budgets help us express our plans. Are we going to grow or contract this year? Are we going to hire more staff or are we going to build out more space? All of those realities, all of those plans take shape within a budget. A budget can help us provide incentives to managers. In some organizations, the financial and budgeting activity is really restricted to the executive director and the chief financial officer, maybe a few board members. And by not sharing the financial and budgeting information with the rest of the staff, they're really missing out on insight and opportunity for savings and or increased earnings. So by providing your managers with the information about the things within their program budget or their division budget that they can have influence or sway, you may find them providing you with great opportunities and suggestions for cost saving, or where there might be an opportunity to either raise funds from a vested funder or a marketing opportunity where there's a product sale that would go right along with your mission and they see on a daily basis that there's a need for that particular item. A budget is also a tool for minimizing fraud. One of the first red flags that an organization is experiencing fraud is when an allocated budget item is completely out of whack from what they expect. Either the revenue expected from a contract is being recorded at a much lower rate than budgeted, or the expenses of a related budget item are much higher than they expected. I share a real example in that one organization I worked with oddly had triple the postage it normally has in the first quarter of a fiscal year and couldn't figure out why, until they realized that the administrative assistant was mailing her wedding invitations using the organization's stamping machine. So very expensive, very nice, oversized invitations going through the organization's mailroom and tripling their costs. However, this would not have been something they were aware of. She was doing it at night when there was no one in the office, except for the fact that they had and they knew how much they spent quarterly on their postage on average, and the number was so out of whack it bore investigating. Effective budgets share three qualities. The first is that they're realistic. They are not made up of pipe dreams or unsupportable assumptions on where you can cut costs. An organization can't miraculously balance its budget by simply saying, and next year we're going to raise 3 times the amount in grant revenue, or we're going to tighten our belt and cut 20% of expenses across the board without specifying exactly where or how they're going to either find these new wonderful funders or what expenses and activities they can do without. Additionally, effective budgets are consistent, and that means the same assumptions and calculations that are applied in one area of an organization are applied in another. So if the average starting salary for a program assistant is $35,000 in one department, unless there is a significant difference in skill set and desirability of the job, you can't make the assumption that the starting salary somewhere else is $22,000. You need to be able to support your assumptions about salaries, expenses, and earnings across the organization based on consistent sets of understandings and principles. The third quality, which is often overlooked in a good budget, is that it's flexible. And that may seem like a contradiction when I've just said that a budget needs to be consistent. But good budgets build in them some flexibility, because a budget is not a document that is started on the first day of the fiscal year and not looked at or had anything compared to it until the end of the fiscal year. Halfway through the year, 3 months through the year, you're looking at your budget and realizing, oh my gosh, we actually did have, more printing costs this year, or gas prices were higher and our van fleet was more expensive to run. With those realizations, a good budget has flexibility built into it so that you have built in contingencies or reserves or overages such that with the first indication of a change in your expectations, you are not required to revamp the entire budget or to pull funds from 3 different categories to cover gasoline costs, but that you have a reserve or you have a overage line item that you can use to make up either shortfalls in income or unexpected expenses. Budgets are projection documents. They are looking forward. They are saying this is what we expect to have occur. This is different than financial statements, which are historical documents, where they are looking back at a 12-month period generally and saying this is what's happened for the organization. A budget is a document that is looking at a future period, usually a year, and saying this is what we expect to happen and this is what we are going to work to make happen. So the projection documents within an organization include the program and project budgets. Those roll up into department and division budgets. There are organizational budgets which address operating income, capital expenditures, and cash flow. And these all become part of business models and strategic plans. I like to think of the building as the budget building process as a pyramid. And at the very bottom, at the widest part of your triangle, is your project and program budgets. You may have multiple project and program budgets, but when those project and program budgets are rolled up to become a division or a location or a site budget, you have a fewer number of budgets. Then all of your department, division, site budgets come together and are partnered with to become the operating budget, and then they're partnered with the capital and cash flow for the organizational budget. Then when you have an organizational budget, you can attach that to the strategic plan or growth strategy for your organization, because if you're not looking that far down the future, the budgeting process becomes very hand to mouth, we're just raising the money or just finding the money in time to pay the bills, as opposed to saying we are going to grow our annual appeal X% every year so that in 3 years we have the unrestricted revenue to hire 2 more staff. In addition to the financial documents that you use to actually set out what you think things will cost or what revenue you think you can bring in the door, budgets should include a budget narrative, and this is a written paragraph or full page that explains to any reader of the attached budget what this budget covers. Is this a program budget, a department budget, the organizational budget? What period of time are we looking at? Is this a 1-year budget? Is this the budget for the next month? Are we looking at this as to be a 3 to 5 year beta program, and so this is the budget for that entire 3 to 5 year launch period? And then we explain whether or not the budget is being used on a cash or accrual basis. And this becomes more important when you span larger periods of time because, as we've discussed in the previous mod, cash and accrual represent different financial realities over different periods. So it's very important for someone looking at your budget to understand whether or not this budget represents the full cash expenditure or if this is some portion of either income or expenses based on use or having it on hand. Budget presentation, I'm sure you've all seen them. It tends to be fairly straightforward. We first present our revenues based on different sources, including, some are grants, contributions, earned income, interest, other, and in most cases that is the order in which you see them presented. After you present the revenues for your program, division, or organization, you then present the expenses. And in most program and project budgets, they do what we call an OTP and personnel budget. And the expenses are presented by two broad categories. The first is personnel and benefits, and the other, creatively named by accountants, is other than personnel, or OTP. Personnel costs consist of salaries and benefits. Benefits can include insurance, accrued vacation, any contribution to a 401k or 403b, and the related taxes. Just because we're not-for-profit organizations or tax exempt doesn't mean that we do not have to pay certain taxes with regard to employees. Outside of personnel and benefits, there are a variety of OTP natural categories, but most of the ones that we will see in common not-for-profit planning include rent or occupancy, insurance, utilities, travel and transportation, small equipment, i.e. things that we are not calling a capital expense, office supplies, professional fees such as accountants, lawyers, and any interest we're paying on any borrowed funds. So on the screen in front of you is an example of a program budget. This is a after-school program, seems to be my favorite go-to. And what we see is the sources of revenue for this organization include enrollment fees, United Way contributions, and then general support allocated from its unrestricted funds to the program. So this is an additional, in this organization's case, $5,500 that was not raised or earned specifically for this program, but that the management of the organization decided to allocate to this program to allow it to make ends meet. So this may have come from the annual appeal, this may have come from the fundraising gala, this comes from another source other than that which was specifically dedicated to this program in the way it was raised. We then move on to expenses. And what you can see in this organization is that we have personnel broken down by salaries for a full-time instructor and a part-time aide, as well as benefits. And then we have OTP, and they're the standard things you might expect that go with an after-school program. This organization runs a very tight budget and has an excess of only $20. What you would note is that without the $5,500 that it received as an allocation from unrestricted funds, it would be in deficit spending. So neither its enrollment fees nor its dedicated United Way funds provide enough income to this program for it to run in the black. And it requires other fundraising efforts by the organization to make this project work. And that's okay. It doesn't mean that it's a failed program in any way. It just speaks to the need for other activities and fundraising events that provide unrestricted funds. On the screen in front of you, we've moved to something a bit larger, which is the organizational budget. And this is beyond a project, beyond a program, beyond a division or a site. This is the operating budget for this organization. And this is where revenue is generated from enrollment fees, grants, So those are foundation or corporation or government funds. Contributions, which are generally seen as different from grants because they are smaller sums of money usually raised from individuals or families. They make $8,500 in branded item sales, and then they earn an additional $5,300 in interest and dividends. So they either have an endowment or money in the bank that is kicking off interest at a somewhat nominal amount, but it amounts to a total revenue in this year of $188,000. With that, they run 3 programs: a breakfast tutor program, the college prep program, and the previously looked at after school sports program. They're running at a total of $123,875 in program costs, and they have an additional $48,250 in management and general and fundraising costs or supporting services. This amounts to $172,125 in total expenses, leaving them a modest surplus of $16,225 for the fiscal year. In addition to an organizational operating budget, organizations need to be thinking simultaneously about their capital budgets and their cash flow. A capital budget is generally associated with the balance sheet and the statement of functional expense. And this is because it is an organization's way of looking at what larger and longer term assets it needs to develop in order to continue to keep its organization's infrastructure strong and for it to build for the future. So included in a capital budget may be a capital campaign or an endowment campaign so that the organization can plan for financial stability. This includes maybe building operating reserves, creating an emergency fund, or actually embarking on a capital campaign to raise a formal endowment. It may include any known or expected capital investment. Do they plan to buy a building? Do they plan to acquire a new fleet of vans? Will they get a school bus for the after-school sports program? These are long-held physical assets which would appear on the balance sheet as a non-liquid asset, but still enhance the holdings and value of the organization. The next simultaneous budget is something called a cash flow budget or the cash flow projection. And this is primarily an internal document, and it actually does not correspond to the cash flow statement in the audited financial statements. But this is a tool that allows an organization to look at its sources of income and when it expects that income to come in the door, and look at its expenses or its cash disbursements and when that money needs to flow out of the door, and then to identify any periods in their operating year in which they might have a disconnect. A perfect example of this is if you run a summer camp. A summer camp will incur the majority of its expenses from May to September. It will have the greatest amount of staff, its insurance costs will go up, its supply costs will go up. All of the expenses associated with actually delivering its primary service are highest May to September. Not surprisingly, most organizations that are focused on running their summer camp from May to September are not fundraising May to September. They are not doing a lot of their administrative management in that same time period. So they may throw their largest gala in November or December. And so maybe they have a huge inflow of funds in November and December, and then they spend all of that money down May to September again. So if you're looking at their cash flow at the end of August, there might be a moment or two of nail biting because, oh my gosh, we've gotten to the bottom of the camp year. We're spending down all of that money we raised last year to run this year's summer camp, and we're going to have to get through October and the early part of November before we get that cash infusion from the gala again. Cash flow projection tool is what helps an organization identify those flows and then manage to them. So one of the things you might do for an organization that has that heavy period of expense followed by a later infusion of unrestricted income is to look at perhaps its annual grant funders and speak to them about the fact that it would be incredibly useful as an annual supporter for you to deliver your grant check to us instead of December 15th when we're receiving the majority of our gifts. But if it was at all possible for you within your grant cycle to issue our $10,000 grant on November 15th, it would make a huge bit of difference to us. It's an opportunity also to look at the way you pay repeat vendors and to negotiate your terms of payment to say, I know that our insurance covers us for the summer camp, but we would like to make our final payment on that on December 15th when you know that you will have more cash in hand. So this is an incredibly useful tool, and it sounds like it should be intuitive, but the number of organizations that fail to project out just the flow of cash in and out of their organization for a 12 to 18 month period is exceedingly high. And simply by understanding your revenue flows and your expense flows, your organization can better manage the gaps in between and take advantage both of the relationships you have with funders as well as explore the opportunities for bridge loans or lines of credit. So a cash flow projection is one of the most useful budgeting tools an organization can develop.